Okay, the attendee growth curve is slowing, so I guess we will get started and allow people to keep joining. First off, I would just like to acknowledge and celebrate the first Australians on whose lands we meet today virtually and pay our respect to their elders past and present. So I'm Ryan Edwards. For those who don't know me, I'm Deputy Director of the Development Policy Centre here at the ANU and a Fellow in the Gordon Department of Economics. Hosting with me, I have Arachika Okazaki, who is our events manager here at the centre, and also does so much more. Thank you to everyone for joining us. From our participants list, it seems like we do have a very, very mixed audience, academics of very different disciplinary stripes, policy folk and practitioners, and pretty good regional representation as well. For those of you unfamiliar with our centre, we're a think tank focused on research and practical initiatives to improve the effectiveness of Australian aid, to support the development of PNG in the Pacific, and to contribute to better global development policy. We were established in September 2010, and we are celebrating our 10th birthday this year. Since our regular events like the Pacific Update in Fiji has been cancelled due to the coronavirus, we have introduced these webinars, which are also a pretty excellent way for us to connect the region to some of the world's best researchers without the expensive Canberra flights, which we all dread. We do record and post these resources online, so you can follow up later and share it with others if you find today's talk helpful. The first two talks we've held were more policy talks. This one is more a traditional research seminar. So without much further ado, I am delighted to have joining us today Cátia Batista, who is an Associate Professor of Economics at the Novas School of Business and Economics in Lisbon, Portugal. There, she also founded and is the Scientific Director of the Nova Africa Research Centre. She holds a PhD from the University of Chicago and has a fantastic portfolio of research on immigration, remittances, financial inclusion, and much, much, much more. Today, Cátia is going to present the paper, Is Mobile Money Changing Rural Africa? Evidence from a Field Experiment. This is a really impressive omnibus paper from a massive field project, so it's not really fair to just call it a paper, and so I would encourage all of you to read it and check it out if you have not already. It's up on the website, up on Cátia's website. We'll hold most, if not all, of the questions until the end of the presentation when we will have a Q&A, and the talk we expect the talk to go for around half an hour or so. So thank you for bearing with me, and over to you, Cátia.
Thank you so much, Ryan, for the kind introduction and for the invitation. It's a real pleasure to have the opportunity to address these diverse audience in a different time zone. So it's 7 a.m. here, so bear with me if you see that I'm not at my best, but it's a real pleasure to do this today. So, and thank you for being here with us today. So I'll be telling you then about these projects on mobile money that we have been doing already for some time, and this is joint work with my colleague Pedro Vicente. So let me start with some brief words of introduction, on the context. So we know that financial inclusion is extremely limited in sub-Saharan Africa, where about a third of adults have an account at a financial institution, according to the 2014 Global Findex, where only about 37% of remittances are sent in a formal way. Now, we are going to focus on rural areas of Mozambique, which is a much less underdeveloped region, okay, compared to this average for sub-Saharan Africa. So here, what we had, the numbers we have, which are not very, and data here is not very abundant, but the information we had was that only 1.3% of adults had access to financial services, which compares to the 1/3 for the average sub-Saharan African country, and where formal money transfers are only performed by or used in less than 20% of urban to rural remittance flows. So overall, financial access here is very limited. So this is where we found an opportunity. Okay, we thought, so mobile money, when we started this project, was about to be introduced in the country. So it had been a huge success in Kenya, where, in 2 years, so between 2007, 2009, you had like 60% of the adult population using the service, 10% of GDP growing through it. So it was a huge success, okay? And it has been growing and developing over time. So this is what was about to happen in Mozambique. Let me just go back and tell you what we understand as mobile money. So mobile money here is the very basic form of having access to financial services in your cell phone. A cell phone that doesn't need to be a smartphone. It's just a dumb phone where you can first of all cash in, okay? And cash in means that you transfer physical money into e-money in your cell phone account. Then you can use this e-money in your cell phone account to transfer to anyone that has a cell phone, not necessarily in the same network. You can also use this e-money to pay for products or services. You can buy airtime. And finally, and importantly, you are able to cash it out. Okay, so if you have e-money in your cell phone, you can go to a local agent and get it back into cash. Now, the key thing to notice here is that to cash in and cash out, you will need a local agent. Okay, so this is your mobile money agent, which is, similar to a bank agent, okay, if you will. Okay, but to make transfers, to make payments, to buy airtime, you do not need the agent. Okay, and this is where flexibility is coming in. Okay, so now what do we do in our paper? In our paper, so the question we ask is about the economic impact of introducing access to mobile money in rural locations for the first time. So our what we do here in this project is an experiment, a randomized controlled trial, where we evaluate the effects of newly introducing mobile money services in rural areas that had no formal financial service at all before we arrived there, okay? So they did not have mobile money, they did not have access to formal banking agents. So yeah, what you had in terms of financial services was informal networks, okay? So that's the status quo before we arrived. And then what we do is the service is introduced, and I'll explain that in a bit. And we'll want to understand what happened afterwards, okay? And so we interviewed 2,000 families to learn about their adoption patterns, about what they were doing, in terms of financial behaviors. So what were their remittances and savings patterns? So did the total increase? Was there a substitution between channels? And then we turn into first order outcomes such as consumption, vulnerability, and we take a special look at food security, which is an issue in these areas, and also investment. Okay, so the other side of a main or first order economic outcome, we look at investment, and we focus particularly on agriculture and business, which is the most relevant for these areas. So we get surprising results. I will preview them in the slide, but let me just say that the mechanism underlying the changes that we are going to identify is migration, okay? So the introduction of this new technology, this new financial technology that facilitates a lot remittances will have the effect of provoking migration out of rural areas. So to give you a fuller story in previews, what we found was extremely high levels of adoption. And let me qualify this. We say extremely high levels because yes, we had the huge success of Kenya, but in the rest of the world, mobile money was slow to pick up. Okay, so in most areas, it took many years. Nowadays, it is increasing, but initially, in most places, we did not see these levels of adoption, such as the ones we saw here. So 76% of households did at least one transaction in the first year, 85% of them in the 3 years after, in which we follow these families. And we use, for these numbers, we use admin data from our partner, the cell phone company that was providing mobile money service. In terms of migrant remittances and savings, we saw that total migrant remittances received increased, and this happened especially in presence of negative shocks. So we use two measures of negative shocks, an aggregate measure, which is a flood. There was 6 months after the mobile money service was introduced in rural areas, there was a massive flood affecting our treated and control areas in a random way. So we could use this flood to see that the remittances received increased a lot in presence of these aggregate shocks, so in flooded areas. We also have a measure of idiosyncratic shocks reported at the household level, and we also see with our admin data that remittances increase in presence of these family-specific shocks. In terms of savings, we don't really see a lot. Okay, so I'll show you that there was no clear changes in overall savings, volume, or methods. Okay, a slight substitution towards mobile money, but not really very sizable. In terms of consumption and vulnerability, what we see consistent with this pattern of remittances was very strong consumption smoothing, meaning that whenever there were these negative shocks, so the aggregate shock, flood, and idiosyncratic shocks at the family level, we see that there are positive average effects on consumption in presence of these shocks. And we also have some measures of vulnerability, namely to episodes of hunger. And what we see is that people report being, suffering from less episodes of hunger when they have mobile money available. Now, this is something that was already observed in different contexts, not with experimental evidence, but we had seen, Tavnit Suri, Billy Jack, they had found similar results in Kenya, okay, using different sorts of data, but they had found this result. Now, what was surprising and new in our study was this result on investment. Okay, so the opposite of what we were expecting from the existing literature on migration and remittances would be that these decreasing the transaction cost of remittances could increase remittances and investment. But what we found was not really this. So what we found is that there are no significant impacts on business investments. Okay, they are not significant, but there are some negative signs. And then we found a significant negative effect on agricultural activity and investment. This was very puzzling to us and was not really what we were expecting. So we had to think about it and try to explain it. And so here we start, just with a theoretical hypothesis based on this model by Munshi and Rosenzweig. And the idea here is that when someone in a rural area is thinking about whether to migrate or not, that person knows that if he stays in his home village, he'll have the opportunity to benefit from informal insurance. As I told you, so in these areas, we don't really have any commercial bank or insurance company operating, but people insure each other at the village level. Okay, so if you decide to leave, at the status quo before there is mobile money, you will lose this. You will lose this insurance. You'll lose the opportunity to support your family, for instance, at the village level. But you'll have extra income in urban areas. So here, the baseline decision, migration decision, is trading off this insurance back home with the income gains at the destination. So what happens when we introduce mobile money? When we introduce mobile money, what we do is we are reducing the transaction cost of these long distance transfers. And when this becomes possible, the result is, consistent with what I've just shown you, is improved long distance insurance. So now, if someone decides to migrate to an urban area, this person will have the possibility of sending money back home when a shock hits. Okay, which is exactly the kind of result that we observe in our experiments. And so this is consistent then with this result where we see migration increasing. Okay, and this is the story we have that is consistent with our results. Okay, so we tried different models of insurance that could be consistent with our hypothesis, namely by Carlan and co-authors, this QJE paper, but we could not find evidence for that. So this is really the story that seems to be consistent with our findings. So the idea here then again is one where we observe spatial occupational change. The fact that mobile money is introduced, the fact that it is now possible to have long distance insurance for these migrants means that people can leave these low productivity agricultural activity and move into high productivity occupations in urban areas. And I should, I mean, in terms of context, I should say that these rural areas are areas in which what you have is subsistence agriculture. Okay, people are really producing agriculture, not for selling in a market, but really at very low levels of productivity, just for, I mean, to feed themselves and their families. And so, okay, so this was a long preview, but you have the essence, and now I'll get into some details, trying to focus on in aspects of design and measurement, but well, we'll have most questions at the end, and I'll hope with that we'll have a clear presentation. Okay, so this is a very long outline, but let me go step by step. So in terms of context for the country and the mobile money market, let me just say that as is typical of most sub-Saharan African countries these days, you have a large number of people connected. So this is actually, so we have here 18 million connections, which is higher than the number of individuals, because everyone has more than one cell phone account. Okay, the market was competitive. So we had MCell, which is state-owned and the main operator. This was our partner because it was the only one that had capacity to reach the rural locations. Vodacom was also operating, although at the time there was no other mobile money service being offered. And finally, Movitel, this Vietnamese consortium, Vietnamese Vietel led the consortium that started Movitel. So this was starting at the time. So these were the three mobile phone operators, and at the time, the mobile money was allowed by law, right? But although it took some time to start, and initially it was only being offered in the capital city, so in urban areas where the company expected to make money. So we did this partnership with Carteira Móvel, which is this mobile money company owned by MCell, the state-owned company, the largest one, and this was our partner in the introduction for the first time of the services in rural areas. Okay, so we have here some more or less technical details that I'll skip, and I'll show you the map. Okay, so here is a map where you can see where we worked. So we were working here in Southern Mozambique. So these southern provinces where you can see that we had 102 villages that we were working with. The red ones, the red balloons, are treatment areas, the ones where we introduce mobile money, and the yellow balloons are control areas, so villages that we're following just for comparison purposes. In total, we were following a panel of about 2,000 families in these areas. Now, one important thing to notice is that these areas, they are rural areas, they are very much underserved in terms of financial services, but they are not the most isolated or the most remote areas. As you can see, even in the southern provinces, here inland, okay, we are not really sampling here. And why? Because mostly there was no, there was no cell phone coverage, and there were very few people. And so these are really the most isolated areas. So here, in terms of external validity, we should be thinking that these results are applicable to areas that are already covered by cell phone coverage. And at the same time, there is a commercial bank in the district, okay? So in the district here means that it probably takes a few hours for these people that are in our treatment and control villages to travel and have access to a bank, okay? But it exists. So these are not the most isolated areas, just to repeat. And importantly, they form an internal migration corridor to the capital city here at the bottom, Maputo, okay? So this is an area in which you traditionally already had internal migration corridors to the capital city. And this was done by design based on the Kenyan experience, where we already saw that migration and informal remittances were an important driver of the success of mobile money. Okay, the thing is, no one could really establish causality, what had come or how things rolled up in terms of mobile money, because it was all so fast that you could not really, make an experiment to try and measure this. Okay, so I'll stay here in terms of details. Let me just now turn to describing exactly what we did in terms of intervention. Okay, so here, let me show you some photos of what we mean by our bankers, our bankers at the time. So these are our shops that were chosen because they had full shelves. They were typically the biggest shop in each village. This is what it looks like. And so the first stage was the recruitment of one mobile money operator. So one of these shops became was registered to become a mobile money provider. Okay, so this was the first step in all treatment villages. There was one mobile money provider. And then there was this community level intervention, okay, which looked like this, where there was a team that was explaining people how the service worked. Okay, so again, this is only applicable to the treatment areas, okay, treatment villages where the service was introduced. Then at individual level, okay, so for those, so this is, we only did this with 20 households per village. And so in the treatment areas, we had people registering for an account, and also we gave them some trial money, so okay, roughly $1 equivalent, and they could see how to check their balance. And well, first of all, they had to cash in. They had to go to the local mobile money operator, cash in, check their balance, and that was like the trial that we did with them. Okay, but they were also taught about how to make payments, how to cash out, how to make transfers importantly for remittances, and they were given all prices. Okay, so there was this leaflet that stayed with them after they were taught how to use the service. Okay, so now how are we going to measure the impact of these interventions? So we are going to use here a combination of different sources of data. So first of all, we have the admin records from our partner that give us data on actual usage of mobile money. Okay, so the brand of mobile money is Mcash. Sorry, I didn't mention this before. And this includes details on the type of transaction, the value of transaction for each transaction performed by each individual in our sample. Okay, and so we recorded this total of nearly 6,000 transactions, okay, over 3 years since the introduction of the service. And obviously the trial transactions we did with people are excluded from our analysis. So this is the first source of data on the usage of mobile money. Then we collected these weather shocks data, okay, because it happened that 6 months after the introduction of the service, we had these major floods. So we collected these standardized precipitation evapotranspiration index, which is arguably the best measure for a flood because it takes into account other weather conditions. Okay, so namely, in addition to temperature and conditions of soil and all of this to have the most possible precise measurement of drought and flood conditions. Okay, so this is what we are going to use when we measure our aggregate shock that hit some of our villages. And then, of course, we have survey data where we conducted detailed interviews with all of the households in our sample, both in treatment and control villages. And this is the way we measure consumption, household level shocks, vulnerability, remittances, savings, and investments. Okay, so we conducted 3 rounds of interviews with a panel of households over 3 years. Then, okay, I won't be spending a lot of time on this in the interest of time. I'll be happy to talk more about it later. So we also have behavioral measures of the willingness to save and remit. So we had some games that we played with people to try and measure how willing they were to use mobile money and what difference would that make in terms of savings and remittances. So this I'll skip in the interest of time. Now, to measure our effects, we will use a very simple ANCOVA specification where we just look. We'll be focusing here on beta. So beta will be our parameter of interest, which is just our ITT effect. Right. So the first question that we need to ask was mobile money used? Okay, so we'll, and here, as I previewed, yes, it was used. So we saw that 76% of individuals in treatment areas performed at least one transaction in the first year after the intervention, okay, and 85% over 3 years. So one question that people often have is, I mean, and looking at the case of Kenya, for example, was that, well, what happened in control locations? So, and in control locations, not much happened, okay? Over 3 years, only 1.8% of our sample was doing any sort of transaction using mobile money, okay? And I should remind you that. So what happened here is that mobile money was not introduced in those control villages, and if they had to use it, they would have to go to some other central location where they would also have a commercial bank. So here, this is the reason why this happened. At the same time, the company, the mobile money company, was not investing heavily in these rural areas, which they were not convinced that were profitable enough. Okay, so that's the story here. Now, in terms of transactions, people were mostly using it initially to purchase airtime. Okay, so but transfers were also a big transaction, a common transaction to be made in this first year. Now, over time, patterns of usage varied a bit. So people started doing less airtime purchases, and what we saw more was like remote payments. Okay, so long distance transactions were taking over at this time. Okay, I'll skip tables. And again, I'll be happy to come back to these and details at the end with the questions. But I want to really focus on the main consequences. Okay, so the main consequences of introducing mobile money here were, first, in terms of consumption smoothing and vulnerability. What we see here is, so here what we are doing is an interaction. So here what we have is this interaction between mobile money, the availability of mobile money in a village, and a negative shock. And so here in the first column, we see the impact of someone in a village that was flooded and who had mobile money available. So what happened to her consumption? Okay, and so what we see here is that it goes up by 37%. Okay, so on top of those who had that had the treatment only and that had the negative shock only. So this is, even when you add up the coefficients, you see that, well, consumption actually increased when people were hit by a shock if they had mobile money available. The same thing happens when people are reporting shocks at the household level, and shocks at the household level could be a health problem, could be a death in the family, or someone losing a job. Okay, I should notice that this coefficient here, it looks larger, but actually, given the incidence of this shock, this should be, for interpretation, divided by 5. So this is actually smaller. So the flood shock prompted bigger effects than these idiosyncratic shocks that could be ensured at the village level. Okay, so this is consistent with theory, with what we expect, in the sense that because mobile money provided a way for remittances to be sent to these families, they are better insured against shocks. And indeed, they even increase their consumption because, presumably, if you have a flood, you have lots of expenses to compensate for the loss you suffered with this flood. This is the main point then, is that we observe that there is here the coefficient of just having mobile money in the village is positive, but not significant. Where we really observe effects is when families are hit by shocks, okay, either at the village level or at the family level. Then in terms of vulnerability and subjective well-being, okay, people report being happier and less vulnerable. Looking in detail, which I think is more interesting, we see that, when we control here for multiple hypothesis testing, and we see here that we even after controlling for multiple hypothesis testing, we have strong results in terms of access to food. So these results here means that people were less often subject to episodes of hunger when they had mobile money available. Okay, and now the question is, how was this achieved? Okay, how was consumption smoothing achieved by introduction of mobile money? And I've kind of previewed this before. It has to do with remittances. But here I show you admin data. Okay, so what we see here is how the total value of monthly mobile money transfers received, okay, in the local currency, meticais, evolved over time. So this is data from the mobile money operator, so admin data, not self-reported, and it shows here the floods that happened in January 2013, and it shows how mobile remittances responded, okay? And one thing that I should notice is there was a very strong response to this aggregate shock. What we see is that it is unparalleled in the usage of this service, I mean, throughout the rest of the time period that we have, okay? So this was really quite a significant shock and response to that was provided by the mobile money service, okay? So, so let me stay at this and discuss more if you wish at the end. So this is the tables that are equivalent or that show in a different way what I just showed you with the graph. They simply say that here, so that we did observe a sizable response, both in terms of whether there were remittances or not, okay, made to villages that were flooded and that had mobile money available, the 11% or 11 percentage points increase. And here we had these huge 73 or almost 74% increase in the value of remittance. So this is exactly the graph that we just observed. We also do the equivalent for household level shocks. And here, okay, again, you should divide these numbers by 5 if you want to compare them with the village flood index. So the magnitude is smaller, but also significant. Okay, and overall, even in villages that had mobile money available, but that did not suffer shocks, so you can see this in this middle line here with the treatment, okay, the effect was always positive. All villages that had mobile money available were receiving more remittances, okay, regardless of suffering shocks or not. Okay, so yeah, so here we use not admin data. So the data I just showed you were for remittances received through mobile money. Here I'm showing you the remittances that we measured using surveys. This is much more detailed because we can measure not only total remittances, but also the ones that are sent regularly. Perhaps you have a worker that is regularly sending remittances back home, and occasional, okay? And these, we do this interaction with negative shocks, and we see that these are responding mostly to shocks, okay? We also have a measure of in-kind remittances where we do not really observe much action going on here. So what we see here when we use survey data, okay, to complement the mobile money transfers data, is that total remittances increased mostly because remittances were responding to shocks, okay? So in a nutshell. We also, and this happens both to the aggregate shocks and to the household level shocks. So now just a very ugly table for savings that tells us that, so looking here, nothing really happened to savings. So to the probability of saving, to the value of savings, the fact that you have mobile money available does not seem to cause any change in total remittances. When we look at different types of remittances, whether people are saving at the bank account, at home, in a rosca, with a shopkeeper, lending money. So, I mean, we don't really see anything here. The only thing that we see that is kind of interesting, minimally interesting, is that there seemed to be an increase in both the probability and the value of savings using mobile money. But I should say that this amount is rather small. Okay, so. But it's interesting to see because we have this from the admin data and we have this from the survey, and the magnitudes are quite comparable, which are just, well, an indirect measure of that reassures us regarding the quality of our survey data, because indeed the effects are very similar when we use survey data and admin data. Okay, so now for the interesting question, and I'll try to keep focus in the interest of time. So were there any effects on agriculture or business investment? And so what we see here when we look at agriculture is that there was a negative effect in terms of active farm. Okay, are you farming your plot of land? So pretty much everyone has a plot of land, a small 1 hectare average a plot of land, and there was here a significant decrease both in the first year after the treatment and in the second year after the treatment, so it increased even. There is this negative effect. Less people are farming their land, okay? And so in terms of agricultural investment, we see a similar effect, stronger in the second year after the intervention, okay? And so what we find here is then people are farming less and they are investing less in their farming, okay? And this was our surprising result. When we look at businesses, we don't really observe significant changes, okay? Particularly after we account for multiple hypothesis testing. So the question was why, okay? And I gave you the preview. So here the idea is then that because mobile money allowed for a reduction in transaction costs for long distance transfers, people got now this new possibility of being insured long distance. They can support their families, the families that they left behind, because now they can send them money overnight, okay? So I should say, and I should have mentioned that the alternative to these mobile money transfers was, I mean, to wait to go home, and that would take, I mean, you would have to take 1 or 2 days just to go home and come back, or wait for someone else to go home, or trust a bus driver that charges you a 20% fee and oftentimes doesn't get there. So it was expensive, it was risky, and it was not immediate. It would take a long time. So this is where transaction costs were reduced for these transfers. This is where we observe an improvement with long distance insurance when we introduce mobile money. And then this is then what seems to be triggering here a response of migration. People decided to make this, what we call this spatial occupational change, which was to move from low productivity activities in agriculture in their home village to high productivity occupations in urban areas. So what we see here in terms of results is then this increase. Okay, so and here I'm showing you also these interaction effect with the treatment, where we see that, and we break it per year. Okay, so here what we see, and I'm skipping details and I'll answer them in 1 minute, but what we see here is that first, in the first year after the introduction, we see some migration as a response to the flood in areas that had mobile money. What we see here is a positive coefficient, not significant for areas that had mobile money, and we do observe migration from villages that were flooded. So let me just say that migration was already occurring because of the floods, even if there were not mobile money, but we get extra migration for those people that were from villages where mobile money was available. Okay, so we do this then for the following year, and here what we see that was specific to the flood disappears, and what we have is we still see people migrating more in villages with mobile money, but not necessarily because they had a flood. Okay, and this is consistent then with the data that we get when we look at the data with self-reported household level shock. So what we see here is not really that people here were migrating because of the shock and because they had mobile money, but mobile money per se was making people leave their village. Okay, and I'll be, let me just conclude now and give you a space for questions. So overall, what we found is that we did this experiment where for the first time we were introducing mobile money in these rural areas of Southern Mozambique. And what we found is that people did use mobile money, okay? Contrary to other settings, people did use mobile money at the high levels, and they achieved, with this usage, they achieved informal insurance to aggregate and idiosyncratic shocks. Okay, so these, again, similar to what Jack and Suri had found for Kenya, insurance and remittances are an important story, are the important mechanism for the impact of the introduction of mobile money. Okay, and this due to these decrease in transaction costs. What we seem to observe that was not obvious from prior work was that this improved remittance sending technology did increase migration out of rural areas, and this implied the spatial occupational change in which people stop doing, or some people decide not to keep on doing subsistence agriculture, and they prefer to move into urban areas where they can take on more productive occupations. Okay, and so I'll leave it here and I'll be taking questions. And I don't know, Ryan, if you want to share this, or if I should just read. I see here some questions in the Q&A.
Yes, we have a few. First off, I just want to say thank you.
Thank you.
That was really great. Sorry that you spoke for the whole time without all the interaction that we normally have. I learned a lot. I'm super glad that you did take the time to share it with us. And I didn't realize, it didn't quite click to me when I was reading the paper, actually, just how salient some of these topics are when thinking about the coronavirus and how people are dealing with shocks at the moment as well. So the timing as well is like really perfect. Yeah, we can go to questions and discussion with the audience. As some of our participants here are already aware, we were unfortunately Zoom bombed last time. And so a big thank you to everyone who did provide their additional details with the registration, because this makes it much more helpful to manage. As you see, we have a few questions via the Q&A, so you can post your question there. Or I believe, do we still have the raise hand function? Or you can also raise your hand in the participants list, and then we can come to you. Please do introduce yourself first if we do come to you, or I'll do it if I know the name and know who you are. But I want to take advantage of my privilege of as being chair and just throw to you two questions I had. I mean, I obviously couldn't fault the paper on any technical issues at all. So I want to kind of just like step back to thinking about policy. You've done heaps of work on migration in general and on the development impacts of migration. How do you, has this study changed how you think about financial inclusion and financial services as a mediator of the impacts of migration? In particular, I'm really interested in the structural change results. So we know a lot about the household impacts, but I'm wondering here how you think about how it feeds into broader economic development, given this within country structural change we see. And then sort of related to that, I wonder how, if at all, the rollout of there's obviously kind of heterogeneous distribution of access to mobile money and banking across the country. Do you see that sort of reshaping the geography of migration within countries as these technologies become more common, or not really? Yeah, that are just my two thoughts, which I find them really interesting.
Okay.
But then, yeah, we can go to the Q&A ones first. I guess Chris was first after that.
Okay, let me take your questions before I forget them. They are not written. So, okay, so I think that's really, yeah, really what we learn. One of the things that we learn from this experiment is exactly about the role of migration in terms of structural change. So this is, if you think about it, it has not been so emphasized in the recent literature on the development impacts of migration, but this is, I mean, this is history. I mean, this is what we have observed: urbanization, people moving from rural areas to urban areas. So what we are seeing here is that actually a good technology for remittances can allow people to make choices that are not so geographically limited. Okay? So what we see here is that people were not migrating as much as they wished because they were not able to provide for their families that stayed behind. And it was probably too expensive to just move the whole family at once. And so some people were restricted here in their migration choices just to stay in the village because they could not reap the full benefit or share the full benefit of migration when they moved. And so I think this is really something that is very important, that is consistent with, I mean, what we observe in history, and that the recent literature on migration and development was not emphasizing. So when we started this project, we were thinking, say, of the work by Dean Young, where you saw that this Asian currency crisis had increased the value of remittances, and for that reason, everyone was investing more in their home villages. This is not what we see here. And this is something that tells us that financial inclusion and improving financial services all over the country, especially in these more isolated rural areas, could be important in promoting urbanization. Okay? And so this is what we are seeing all over Africa. What you see is huge mega cities growing with lots of challenges that we need to work on, and this is related to financial inclusion. This is what we show here. Now, the other point is where exactly we are working. Okay, and so again, so these are areas that are not the most isolated. These are areas that are actually very typical of, these are areas that are very typical of rural areas in sub-Saharan Africa. So in other countries, well, especially in neighboring East African countries, we see this sort of setting, okay, where there is cell phone coverage, where there is a commercial bank a few hours away. And in this setting, we see that introducing these mobile money and financial services does make a difference. Okay, so I think this is really this is important. Again, we are not talking about very remote, very isolated areas that still exist, that have not as much population, but still exist, and those are, currently there is no technology to serve those people. Okay, and so they are still underserved. But in these areas that are the most common that you see across rural areas, especially in East Africa, you do see that, well, maybe it can make a difference. Okay, and we saw, we just think about Kenya, and we saw the explosion and the revolution that was that in each corner you have a mobile money agent, and these remittances are really thriving. Okay, so I think that's what I have to say for your question. And now,
we can work through these ones. I don't believe the audience can see the Q&A, so we can either cut to you, cut to you, Chris, or we can read out the question. Since Chris is short, we can just read it out. It just says, how are the 20 people in each treatment village selected? And were there spillovers villages?
They were selected randomly in the village. And we did have a measure of spillovers that I was not showing, but they were not, the effects were not significant. So when we put everyone together, the effects are there, but they are not, they are much more noisy, and we don't have a large enough sample to measure spillovers with precision, unfortunately. That's why I'm not showing those here. But the sample was randomly chosen within the village.
Okay. Next up,
you read the question?
Acho's on. We'll just switch to you, Acho, if that's easier, because it's a long question. Where are you? I'll allow you to talk. Yeah. You should be able to talk now, Acho, if you unmute.
Can you hear me?
Yes.
Okay,
yes.
Thank you. Great presentation, thanks. My question is, I wrote it down there. So when a migrant sends remittance, she or he doesn't really just send money, but he or she is also sending a dream, either directly in terms of stories about big cities and things like that, or indirectly, or giving signal that more money means better life in the cities. So this then motivates the receiving ends, creating aspiring migrants. And when these latter groups do migrate to cities, rural agriculture is relatively abandoned. So agriculture's productivity goes down, agriculture sector loses attractiveness, and hence the reduced investment. Does that sound right?
Yes, but your story is much nicer than the one we can tell, because you are telling about the whole history or the whole story of remittances, in which it has to do also with aspirations and information that are sent through migration. So I've done a little work on that, other work on that, on information and remittances, and that is obviously very, very important. We are not measuring all of that. So what we see is that indeed, people are migrating, they are sending these remittances, they are providing for their family, and when they leave, there are less people working in agriculture. Okay, so that we measure. Now, how? No, I'm not sure. I'm confused. I'm already answering other questions, but
that's good. Thanks.
Yeah, so here, the agriculture, this is low productivity. So I think this is Satish. I don't know if you want to talk. I was already answering the question that Satish wrote.
So Satish Chand, a professor at University of New South Wales, has asked, how do we know that migrants moved out of low productivity agriculture? And you just kind of commented.
Yeah, so I was jumping onto that question. So here, okay, so we have done some work on in these rural areas. So we have done also some work on agriculture, and these are indeed very low productivity areas. So in other words, we actually use mobile money with farmers, okay? And so, and we were trying to incentivize their savings so that it would be used to invest in fertilizer, okay? So the context here is a context that, I mean, even compared to the average sub-Saharan African country, agricultural productivity here is very low. I mean, that's why we were asking about the incidence of hunger, because it is a frequent event, okay? So this is the setting in which we are working. And again, if you want to think about external validity, you'll have to think about rural areas where this type of, I mean, low productivity agricultural, small plots, or average 1 hectare plot is being explored. So this is the setting in which these results are obtained, okay? So people are switching from agriculture to other occupations, presumably higher productivity in urban areas, because what they have back home is a type of agriculture that is not using improved seeds, it's not using fertilizers, it is really very rudimentary. And that's the sense in which I was answering Ryan, that this is a bit about history in the sense of, yeah, moving from very low productivity agriculture to urban areas and different sorts of activities.
Okay, so we have Ron Duncan with his hand raised in the chat. I'm going to unmute you, Ron. Oh, you have to unmute yourself. I've asked you to undo it. Ron's an emeritus professor here at the Crawford School. You should be able to unmute now, Ron.
Yep.
Yep.
That fine?
Yes,
thanks,
I can hear you.
Thanks, Ryan, and thanks, Cátia, for a very interesting presentation. There's been an awful lot of work looking at the question of whether remittances lead to investment and economic growth in the receiving countries. And so far, no one can really find solid evidence that there is an impact of remittances on economic growth. So I've done some of this myself in Pacific Island countries, where, say, in Tonga and Samoa, 2 of the highest per capita remitting countries in the world, and there's no evidence of impacts of remittances on economic growth. The IMF group that's been doing a lot of work on this issue, their latest hypothesis is that the remittances, when they're high enough, have an appreciating effect on the exchange rate, which of course hurts exports and therefore hurts domestic activity. As well, they argue that the fact that remittances are taking pressure off the governments to do things for poor people lead to poor governance. Thanks.
Absolutely, yeah. Natural resource curse applied to remittances. So that's
exactly.
A typical case of Dutch disease, and absolutely that's the macro picture. One thing I should say here is that a limitation of our results is that we are only talking about internal remittances. I would love to do this work with, mobile money that allows for international remittances. This is something that we tried to do at the time. We were partnering with this cell phone company, the largest one, the state-owned, but we are also talking with the Central Bank of Mozambique, and we were hoping that they could work with the Central Bank in South Africa to make this possible, because there is most migration, international migration from Mozambique is to South Africa. So there are international remittances being happening. And yeah, the evidence, for this case, so I've done other work that were tended to, not only remittances, it was remittances plus migration, hard to distinguish. They were promoting entrepreneurship back in Mozambique with return migration. But there is no, as you said, okay, we don't have solid evidence on what exactly is the impact at the macro level of economic growth. And so here I must say that, well, our contribution is limited. So what we are doing very specifically is on internal remittances. So we do not have this kind of exchange rate effect. And what we find is that, well, it is not clear that this is going to promote the development in terms of business or higher productivity at the origin. But again, I mean, this is only within the country. So I'm afraid we are not able to contribute to this debate on this broader debate on the impact of international remittances, I'm afraid. Well, hopefully we'll be able to do it in future work.
Right, thank you.
Okay, let's try.
Thank you very much.
One last question. And since a few with their hands up are our own faculty, let's give preference to Russell. Russell is a professor of economics at the University of Sydney. You should be unmuted now, Russ.
Yes. Can you hear me?
Yes.
Okay. I had a couple of questions, but given the time, I'll ask the one about mobile phone use. So I was just curious about use of cell phones just for communication apart from mobile money, and whether the treatment could lead people to use their phones more to communicate, and whether that might then explain some of the results. So, you know, might have more information, which might allow them to consumption smooth better. So like if we ran like mobile phone use as an outcome in the treatment regressions, would we see in there? Would it explain part of the effect? Curious about that.
That's a great question. We have not checked for that. I mean, we have checked for several things, but not, and I think we have it. So let me just say that, again, so these areas are not the most isolated. Here, pretty much every household had a cell phone, okay? So people were using them. We have some data that I did not check before and after for at least how easy it is for you to use a cell phone, because some of these people are illiterate. So I should check that. That's a really good suggestion that we have not checked. Okay, I should say that everyone had a cell phone pretty much. People were using it, but has this changed after the introduction of mobile money? Could this have worked in parallel? This is something I should check. Thank you so much for the suggestion.
Thank you for the great talk.
Thanks.
And apologies to the few that we have not had time to get to, but we are at time. So a huge thank you to Professor Batista for joining us first thing in the morning in Portugal. And a big thanks to everyone else for dialing in and for your interest. Please do feel free to sign up to our various centre newsletters or send me any suggestions, including yourself, for future speakers or how we might improve this series. It's going to be at least monthly. Next up, we do have Michael Clemens from CGD and Satish. I hope you've been told Satish is on the line. And after that, we have Alexandra Peralta from the University of Adelaide. And I very much hope you can all join us for those two as well. Anyway, with that, I'll draw it.
Thank you very much for this opportunity. It was a real pleasure. Thank you for the invitation and everyone for staying with us. Thank you.
Thanks so much. I'll draw it to a close now. And thank you again, everyone.